Good evening and welcome you all to Tideway's summer webinar. Just by way of introduction, my name is Seymour Banks and I'm joined here this evening by James Baxter. Most of you will know as the founder of Tideway, I think 15 years ago, James. It's all passed in a flash, no doubt, for you.
The years fly by.
But also Nick Gate, who's our head of manager research. And the objective tonight is really to reflect on investment performance for the last 6 months, so year to date to the end of June, and also to think about the impact of what is this extraordinary victory for the Labour government. Introductions out the way, I will kick off with a couple of questions, one for each of you. James, we've mentioned the fact that Labour has come in with a landslide victory. What do you think? What's your view on that, just generally? Years gone by, certainly 3 or 4 years ago, if Corbyn had come in, you'd probably be quaking a little bit in terms of what that might mean for markets. But realistically, certainly what we've seen in the short term, sterling's up a bit, markets are up a bit.
Stock markets have been completely unmoved. I mean, when the exit poll came in, I don't think anything moved at all, and the exit poll was incredibly accurate. So I think this looks like a pretty centralist Labour government, and I've been away for the weekend with some of our clients and some of my sailing mates, and we were talking about it. And he looks like a sensible politician who's in it for the right reasons. He's very competent. He's a lawyer. He knows what he's doing, and I don't think there's too much to be too scared about at this point in time. It's obviously early doors, but I think there's no reason to be panicking at all about financial markets.
It's quite a turnaround. When we held our first webinar, I said at the start of this year, we were commenting, I think, on the fact we'd had 4 Conservative prime ministers in the last 2 years.
Yes.
And if anything, we might be looking at 1 Labour prime minister, certainly for the next 4 or 5, possibly the next 8 or 10 years. I said right at the start, one of the main objectives before we get into questions is to review performance year to date across obviously different asset classes, but also perhaps to reflect, Nick, on the managers that we've selected as well. But to kick off, how have we done in fixed income and equities year to date?
We've enjoyed solid performance across all portfolios recently, so multi-asset, equities and fixed income. Just to give you some perspective on the returns there, the numbers I'll quote following are all net of fees. So on our multi-asset portfolios, of which we have a number, returns have ranged from 3% to 5.5%. In our 2 fixed income specialist portfolios, the returns have been 4% and 5% respectively. And our equity portfolio has returned just shy of 8%. For those invested in our short duration fixed income strategy or liquidity portfolio, you'll also be glad to know returns have been ahead of cash and money markets over the period, returning at 2.7%. So doing what it's designed to do. Speaking about fixed income more generally, so we had a very good.
It's worth interrupting. I mean, it's just worth saying those are half-year numbers, so you can double those numbers in terms of a whole year. Whether we see those amounts of returns for the next 6 months, we're more confident as ever in fixed income than we are in equities, but we'll talk about that in a bit later. But I mean, what you're seeing there is returns from sort of 6% up towards 10%. And the good news now is we've got inflation sub 3%. I think, is that right, Nick?
Yes.
So we are now going to have a really big year, it looks, in terms of a real return.
Yeah, to continue on to, perhaps the more granular detail. So when looking at fixed income, performance has been exceptionally strong there. And it's been strong for, predominantly 2 reasons. The first is our duration positioning, which we continue to position ourselves at the shorter end of the curve. With the yield curve still being inverted or flat, we're able to take a higher yield from assets without any additional interest rate risk, which we like. Plus we also have a view that potentially longer term yields aren't as predictable with demand and supply and growth factors thrown in there. So we're very happy with our positioning there. It's been accretive this year, and we're not looking to materially change that at this point unless conditions change. And the second point which has driven performance is strong credit selection from our fixed income managers. So just to name a few funds here, the Titan Hybrid Capital Fund has now returned 7% year to date, which actually the manager informed me this morning that it's top of the Investment Association Strategic Bond.
It's not shy.
Table year to date. And we have other managers there. Royal London, Sterling Extra sits in third. And our newly added Man GLG Sterling Corporate Bond sits at the top of the sector.
Moving on to equities.
So
talk about fixed income.
Equity performance. So equity performance in the period was solid. As mentioned, return roughly 8% net of fees. This was in line with the peer group. As we will go on to discuss, I'm sure a little bit more following now. The markets, like in Q1 and post-NVIDIA results in particular, have continued to be dominated by a select few global US technology companies. I think it is fair to say that if you were to look at the benchmark returns for the quarter, they've effectively been dominated by NVIDIA, which contributed to around 45% of the return, and then two of the other global large cap.
And Nick, just to put NVIDIA in perspective, as I understand, it started off the quarter at valued at 2.2 trillion, and it's finished at just above 3. So that's not 800 million, that's 800 billion of increased value, per obviously as priced in the stock market. But 800 billion on its own is, what have we got? BP valued at less than 100 billion, and not only that, volatility in a couple of days might be the value of BP. So it's extraordinary events happening, especially in the US equity markets and especially in US tech.
The big thing with the indices and NVIDIA is really the amount of risk that we're taking in the portfolios. So we've faced this dilemma all year. Do we put more in the index fund, or do we hold our active managers? Now, the interesting point is that the active managers, it's not that they're doing badly. I mean, the average return on our portfolios taking out the index is still probably 7 or 8% for half a year. So we're on track for a very impressive year from equities. It's just that we haven't made the 12% that the index has made, which owns this, 7 or 8% holding or 9% holding in NVIDIA. So, and the question there is that, NVIDIA is trading on this massive PE, 74 times. So we could go in there and follow the momentum of the rest of the market. But it just feels better and more conservative to stay with our active manager with some exposure to the index, but not all in, because, there is a concentration. It's a concentration risk, and any company that, is seen to be dominating the whole world, it's not going to last forever. We're actually seeing in the last few days, Samsung had some brilliant results in Japan, and we're seeing other chip manufacturers taking their slice of the AI market. And we're also beginning to understand AI a little bit better, that it's not something new and magic and different. It's actually just taking computing to another level. And actually, there's going to be no priority owners of AI. It is just going to be the way that we move into computing in the next generation. So I just think it's prudent from our perspective to, we're outstripping our target returns at the moment. How much risk do we want to take? I think we're at a comfortable level at the moment to put it all in the index to try and chase that momentum return at the risk of a sell-off. It just doesn't seem worth it.
And to put it in perspective as well, we saw transformational moments in the tech sector previously, potentially, in particular with the internet coming on. At the time, we had some stocks, the likes of Cisco, Intel, which we thought were going to dominate for years to come. But in terms of actual performance,
so you'd be rude about my Intel stocks,
Nick. How do you feel? I mean, the reality is that wasn't the case. You have great companies at great prices. That doesn't lead to necessarily great performance.
Yeah, I'll echo what James has just said there. I mean, it is concentration risk, which is, yeah, the main headwind, plus relatively high valuations.
I mean, I'm not convinced that Nvidia's going anywhere in the short term. From what I can hear, it wouldn't surprise me that they don't have blowout earnings again in the next quarter and possibly again in the quarter after that. But at some point, they're going to get caught out, and then you can't maintain a 74 PE for very long. I don't think it is just, and particularly not in a relatively niche market where there are so many competitive offerings. So I think at some point they will become more normalized, and we think that the market elsewhere is more undervalued and lower risk and possibly better returns. Nvidia may carry on knocking the lights out, but if we're making high double-digit returns from the rest of the world, do we really need to chase that extra 3 or 4% or 5% by putting all our eggs into an index which is dominated by a couple of players that are very fashionable at the moment? And I think the answer to that is, I would hope that most of our customers would agree that they'd rather earn 12% safely than earn 15% with more risk.
You mentioned obviously fixed income. We talked a bit about equities now. There is a question coming in with respect to our alternatives bucket, and it's very specific in respect to the managers that we have in that bucket. And the question is, are your convictions in holding the rougher diversified return, Schroders City, and the Franklin Templeton Infrastructure Fund as strong as they were? So what is the likelihood of a potential change of the guard in terms of our alternative portfolio, or are they actually, you comfortable with the purpose, the reason why we have them in our portfolio?
No, thank you for the question. Obviously, I can't speak for the investment committee here at this very moment, but yeah, from me personally, as a fund selector, I fully maintain conviction in each of those three strategies. Can go on to discuss. I think rougher is probably the most pertinent one to discuss, considering the last 18 months. As a reminder, the aim of the rougher mandate is to not lose money over a rolling 12-month period and to protect client money in the event of a huge market stress event. Obviously, so in effect, we hold that as insurance and diversification in the portfolio.
The reflection, though, is that portfolios remain very diversified.
Yes.
And
lower risk,
to be resilient
and lower risk than the index. That's the point.
We see the big picture, Labour landslide victory, but very comfortable in terms of the markets. So from the investment management perspective, we're quite happy with the situation, comfortable with the portfolios and how they sit currently. Another question has come, but it's relative to financial advice, and in particular tax. Well, actually, in this case, it's actually pensions, but we're going to talk about tax a bit later. And it's a simple one. Is there going to be a raid on pensions?
Talk about the tax first, if you don't mind, Seymour.
Because
I think the modus operandi of a financial advisor is, I should now be scaring you all the pants off you all and saying, oh, tax is going to go up, or we've got to do planning, we've got to do this, we've got to do that. The reality is that Kia is walking into a situation where tax receipts are up. Their forecast is that the budget deficit will have disappeared within the next 4 or 5 years, and these are all set by the growth in the economy, nothing to do with fiddling around with tax rates. And if you look at what he's been saying and what he's done, how he's acted in the last few days, he's set up 6 things that he's got to do as his priorities. He comes in, immigration, he's already cancelled the Rwanda issue, the NHS strikes, the prison crisis, planning reform, and then UK relations internally within the United Kingdom and then with the euro. Tax is not even mentioned in there. And I just don't think that it's high on his agenda to start fiddling around with tax. We've got an autumn statement coming up where he may well make a few changes. But I just...
And that's reflected, by the way, in the manifesto, when he explicitly said there were going to be no changes to national insurance, to VAT, to income tax, and to corporation tax. Bearing in mind that's 75%.
Yeah. So you could say, well, okay, what else is he going to fiddle with? So he has got some other things to fiddle with. But, capital gains tax, we know that if you increase the rate materially above 20%, the receipts go down. In inheritance tax, the receipts have been creeping up. But if he tries to be too cute with inheritance tax, people will find a way around it. So if he's smart, he'll try not to, he won't be too political. And he'll just enjoy the buoyant economy that is inheriting and that is growing, and the bigger tax receipts, and maybe he doesn't have to change things too much.
Which leads on to pensions.
Pensions.
Is there going to be a raid on pensions given the size?
Look, pensions are definitely, we've almost had no negative changes to pensions. I mean, the lifetime allowance was a negative change, but it's been now reversed. I suppose it's been reversed, leaving the tax-free cash sum fixed at sort of 250,000-ish. I don't think it's a big thing for him to go at. I think, the pensions freedoms was hugely popular. The ability to leave unused pensions assets to the next generation rather than see it disappear in tax has incentivized people to save. The savings gap, the need for people to have private pensions has never been bigger. So, I'm not convinced it's top of his list to start fiddling around with the pensions rules. And if generally, we don't change things retrospectively in this country. If you've been investing into a pension for 30 years on the expectation of a lump sum, when you come to retirement, I don't think that he's going to be the Prime Minister to remove that right. So that's just my view. I think he might have a fiddle with it, but I still think that pensions should be the first long-term savings vehicle that we all turn to make sure that we're not impoverished in our retirement. I think really, the emphasis has got to be on better education, financial literacy, so that people use their pension savings more effectively, and they don't sit in cash and they don't make bad long-term investment decisions. These are important issues, and he could be the kind of guy to tackle the practical issues than going for the quick political shot. He doesn't need to do any political shots in the short term because he's got such a majority. He's got such a majority in 5 years ahead of him. So I think, with a bit of luck, and I'm always the pint of Young's half full man. If that, I'm hoping he's going to be practical and not political.
I do have a question coming in. It a little bit reflects some of what we've discussed, but what about leaving pensions to the next generation? Are you thinking this won't be changed by the new government?
Look, I think that people underestimate the importance of pension saving and the need for people to save into pensions, and anything that makes pensions more attractive, I think, is good for the government, because it releases the pressure on benefits at the back end. Because if we have more people with more personal savings as they come to retire, there'd be less pressure on the state. And so the general pressure is to try and get people to be more prudent and save more. So is it really a good thing to come out and reverse what's been a very popular set of legislations to allow pensions to be passed on? I mean, they were able to be passed on before pensions freedom, but there was a tax, and it's possible that there might be a tax in passing those pensions on, but it's still better to pass on 60 or 80% of something than 100% of nothing. So I think that the ability to pass unused pension savings onto the next generation is definitely there, but I wouldn't not spend my money in retirement on the hope that I would be able to do that. I think you've got to spend freely in retirement and enjoy your income.
No, I agree. But in terms of also what pensions are spent on and the risks that are underlying those pensions, we saw in the Conservative government an intent to try and encourage spending on more kind of venture capital type investments in order to encourage just entrepreneurial innovation, etc., within the economy. Is that something we have clients who have in different parts of the world that have seen much more, I'd say, encouragement for that kind of investment? Is that something you see Labour government, ironically?
Well, interesting enough, if you're referring to the Canadian situation, which we know reasonably intimately, I mean, the government is trying to make it even, because actually what the Canadian pension schemes have done is invest in infrastructure and real estate and private equity, but they've done it globally. They haven't done it all in Canada. And there is a mood in Canada to try and get them to encourage invest more locally, but it's hugely unpopular. And I think
There's no reason why Labour government should.
No, I don't think that telling people where to invest their money is generally a good idea. I think the market should be free. We should be able to invest where we want, and the best investments attract the most money. So I think it's better to focus on the carrots than the sticks. There you go.
Very good. And this is great. So we're getting a few more questions coming through. A really interesting one in terms of structures and how investments are structured. Do you feel that offshore fund investments, so I talk about offshore bonds, I imagine here, might be more advantageous than a general investment account as part of an investment strategy for clients in retirement?
Right. So, well, that is a lovely question. I don't know who's.
So it's anonymous.
Anonymous. Well, okay. So yes. So look, offshore comes with all those sort of Maltese and Gibraltar and all of those sorts of connotations, but actually, really, with an insurance contract, which is what we use in an investment bond, the fact that the insurance company is placed offshore isn't a massive issue. It's an insurance company, it's an insurance wrapper. And the legislation for the taxation of insurance wrappers has been embedded in stone in the UK for as long as I've been a financial advisor. So it's pretty stable, like the pensions rules. Generally, it's pretty stable. So we do like the offshore bonds as a way for people who've used up their SIPs, used up their ISA allowances, and have got a few $100,000 in their GIAs. If they want to go beyond that in terms of their investment portfolio, the offshore bond is a very good way of deferring tax and giving people the flexibility to, let's just say I've got Keir completely wrong and he decides to bring in a 60% or 70% income tax rate towards the end of his tenure, just to show how Labour he is. The offshore bond would give you the opportunity to stop paying tax in that year, defer it, and pay it in a later year at a better rate. So I think there's always if you can earn money and defer the tax, is always better than paying the tax along the way. I mean, we've certainly, we don't want to crow too much about it, but I mean, goodness knows how much tax we avoided by people advising people to avoid the lifetime allowance tax by deferral. It's probably runs into tens of millions, and that tax just now has disappeared. So that's a complete windfall to our clients. So I think the offshore bond is a very nice vehicle. It's very safe. It's not a highly contentious tax break. It's a normal tax break for insurance products, and I think it's
out of tax income, and you get the gross roll up as well.
Scenario, if you want income, a higher level of income, or to have the flexibility to pay the tax when you want to pay it, as opposed to every year, then
and enjoy the gross roll up as well.
Yeah.
And funny enough, you mentioned the lifetime allowance there, James. We got a question regarding, could it be reintroduced? I mean, I thought that the Labour government said it wouldn't, but if so, if it was at the last level, we're back to somewhere between 1.1 million and 1.8 million, and reinstate a full 25% PCLS.
Well, I will stick my neck out here and say I don't see that tax-free cash going up. Probably, I think he'll keep it at 250,000 at least for a few years. I mean, I did look at some statistics, coming in readiness for this. I mean, what is set in stone at the moment, done by the Conservative Party, is a steady increase in taxes by the freezing of all the allowances and the freezing of the tax-free cash sum and all of that. So he's inheriting a plan which gets him to a zero budget deficit by 28 if he sticks to that plan. So he doesn't have to increase taxes any more than the Conservative government had already set in train. He just needs to maintain the status quo. So I'm not sure that the LTA was very difficult a tax to do. they've wavered around about it. They said immediately they would bring it back, then they changed and said they wouldn't bring it back. I think it's quite complicated to bring it back. I don't think that we'll get a tax that, I mean, I think we might get some sort of tax on pensions, but I don't think it's going to look like a lifetime allowance type tax. But I also don't think that we're going to be able to have 25% of 2 million out tax-free anytime soon.
It's not going to increase.
Right.
You talked about the Canada model of
Yes.
investing, at least within Canada. What about the new 5,000 GBA ISA? Is that something continuing?
I'll take this one.
The younger generation.
Yeah. Yeah,
it's a non-starter.
Yeah, so yeah, in short, the answer I believe is yes. They did some analysis was done by a party who I cannot remember, which basically recorded the entire population who was able to subscribe fully to their current 20k allowance anyway, and that number's not high. And so yeah, if you had all those same individuals subscribing that same 5k, then yeah, the number in question isn't material. And the second point raised was essentially, well, if you're given this extra 5k allowance purely to invest in the UK, why not just take out your UK exposure in your main ISA allowance, and so you come to net zero there effectively. So I'm not sure it'll materially affect the overall ratings for UK equities, especially when you consider the size of the outflows which have happened before this. So yeah. Non-starter.
I think we'll put it in with national service as one of those
conservative
genius ideas that probably was never going to fly.
But nevertheless, other wealth taxes. Do you think we discussed that a bit earlier, James? A possibility.
I think a wealth,
what range is it going to come?
I think a wealth tax is probably on the cards, but I think it wouldn't bother. And we're fortunate enough to have a relatively well-heeled population of clients, and how many of our clients would be affected by a wealth tax? I think less than 5%, less than, if they bring something in, I think it's going to be quite, more than 5 million, possibly more than 10 million. I mean, the real big numbers are in the 50 million and upwards, where a tax would be material. And, there have been a few, and there's also been a number of those individuals saying they quite like to pay some tax. So if they quite like to pay some tax
in the US, Warren Buffett,
I'm the Commodore of a sailing club. If anybody offers to pay more fees, I say how much. So if there's people offering to pay tax at that level, and some of them I think probably would prefer to pay a higher level of tax than necessarily being under pressure to make donations and stuff all the time, why not? I don't think it's a crazy idea.
Interesting. Considering the world outlook, would it be prudent now to be more adventurous in investing? I'd just like to comment. I think we were looking, at least reflecting on the fact that the outlook from a UK perspective is certainly more stable. I wonder if the world outlook appears any more stable. I question whether that's the case, but nevertheless, is there a case for investing more adventurously? The reality is, of course, certainly within equities, we do invest adventurously in the sense of on a global basis. I think we now have, it's 4% of the index at least is UK equities. Within our portfolio, we'd have a higher percentage generally. But is there a case, I think the question relates to the fact, perhaps investing more in emerging markets, for example.
Yeah, go ahead, James.
I'm happy to try that one. I mean, look, I think that's a very personal question to each client. So there's two ways you can invest money. One is, for speculative capital growth, and the other is about, I can't lose this money. I just want to grow it above inflation, real returns. So, we are, Nick and I are working on a high growth equity portfolio, which we, without putting ourselves under too much pressure, we might well launch in the next few months. And that would be one where we sort of take the seatbelt off, if you like, and say, yeah, let's just see where we can get some outsized returns. But I think if you're investing what we call the irreplaceable capital, then you start from a position of the three upfront strikers we mentioned in the fixed income, Royal London, Titan, and Man GLG, are all looking to make, on current rates, they're all looking to make above 10% this year. 10% with inflation at 3%, without having to speculate in equity markets, that is, for me, that still looks like a very big sweet spot. Of course, we might get 13 or 14% in equities, but the degree of uncertainty when you move from fixed income to equities is huge. And so even though the returns look close together, don't believe the risks are similar. The risk in equities is much bigger than the risk in the fixed income funds. So the fact that we're enjoying these great fixed income returns, and we have seen a few clients actually take themselves out of equity markets and just say, look, I'm very happy with that, and I'll make 7 or 8% for a couple of years, and then we'll worry about the equity markets in 2 years' time. And that's not a bad way of approaching life either. If you're trying to, make 20% per annum, then you're not going to make that in fixed income. You're going to have to buy equities, and you might make it in the index, but it's getting tougher.
And that actually leads nicely onto
the more the market goes up, the more certain it is that there'll be a correction. Yeah. We don't know when it will happen, but you get two certainties in life with equity markets: is the more they go up, the more certainty there is of a correction, and the lower the future returns. So,
And we talked about a poll at the beginning, and comparing where we thought equities and fixed income comparative performance for the rest of the year. If I get this right, I'm going to launch the poll now. So you should see on your screen, you should have the opportunity to select either equities or fixed income. Which asset class do you think is going to perform better in the second half of the year? So look forward to getting your answers to that. And curious to know if the answers might have changed during the webinar. But nevertheless, we're having a pretty even balance at the moment.
The exit poll. Let's see how good the exit poll is.
So it points to a balanced portfolio.
It's 50-50.
Overall. I think we've pretty much got 50-50.
Diversified portfolio of fixed income equities.
But that in itself actually is quite interesting.
It is quite interesting.
Nobody has a crystal ball, ultimately.
No.
I think we're coming up then to the end of our time. We've answered all the questions, at least on screen. Yeah, at least all the ones that I can see. Let the poll go on for a bit longer. Yeah, so far. I will end the poll at the moment based on a 53%. There's slight overweight to equities versus fixed income. We'll reflect on that in future webinars.
We should have asked whether England would move through the next stage. That would be an overwhelming yes.
Sorry, I should have shared results, but there you can see, hopefully everybody can see what the results are. I've stopped sharing. I will end the poll. And just to finish by basically thanking everyone who's attended this evening. I hope you found it interesting. We will produce an edited version in due course, which you might find useful. Also, just in terms of reflecting, I think it was interesting, that last question about being more adventurous. Certainly, there's an element of complacency here, in the sense that we think the economic situation is reasonably under control. Inflation has subsided. Markets are doing well, relatively well across the board. We have political stability in the UK. What a wonderful situation to be in. When we speak next time, the October webinar, we'll be reflecting, I think, on the US elections, which will be looming large. And question, I guess, is whether Biden will be a candidate or not. Many of us hope not. But in the meantime, just want to wish you all the best for a summer ahead, hopefully some sunshine, and happy holidays.